The housing market is collapsing faster than experts predicted, and the warning signs are flashing red across America's most expensive cities. While Wall Street celebrates stock market highs, 42 major housing markets are already experiencing falling home prices, with some cities seeing double-digit declines that haven't been witnessed since the 2008 financial crisis. Here's the proof. According to the latest data from Redfin and the Zillow Home Value Index, 42 of the nation's 300 largest metro area housing markets are seeing falling home prices on a year-over-year basis. That's up from just 31 markets last month. We're witnessing the fastest deterioration in housing market conditions since the Great Recession, and it's happening right now. But here's what's really shocking. Tampa Bay is the only one of the country's 20 largest metro areas to consistently report year-over-year price declines on the S&P CoreLogic Case-Shiller Index, including a 1.46% drop from February 2024 to February 2025. And just south of Tampa, in the Northport, Bradenton, Sarasota metro area, home prices fell 13% from the first 2 months of 2024 to the first 2 months of 2025. The data doesn't lie, and it's painting a disturbing picture across America. According to the latest research from Altos Research and Housing Wire, 5 states are experiencing actual home price declines right now. Washington has the biggest decline at 0.9%, followed by Georgia at 0.8%, Montana at 0.2%, South Carolina at 0.3%, and Texas at 0.1%. But that's just the beginning. 3 other states, Florida at 0.2%, South Dakota at 0.3%, and Louisiana at 0.4%, have grown by less than 1%, which historically signals an imminent downturn. What's particularly alarming is that according to Zillow, monthly home values dropped in 27 out of the 50 states this year, with Florida, Colorado, Washington, D.C., California, and Washington State experiencing the greatest value declines from March to April. Let me break down these specific numbers that should terrify anyone holding real estate in these markets. Austin, Texas is seeing prices down 4.5% in the past year, according to the Zillow Home Value Index. 26% of Austin's 11,073 listings have been reduced in price, with inventory up 25%. Tampa, Florida is where the carnage is most visible. Tampa experienced the largest month-over-month decline in home prices nationwide in January 2025 at negative 1.6%, according to Redfin. Even more shocking, 34.9% of homes in Tampa underwent price drops in January 2025, up 4.9% compared to last year. Phoenix, Arizona tops the list with 31% of home listings seeing price cuts. The city currently has nearly 19,981 properties on the market, a 33% increase in inventory compared to last year. Northport, Florida has 30% of listings reduced in price with 11,234 listings, up 32% year over year, and homes averaging 70 days on the market. What's even more concerning is that Florida's housing market data shows a clear pattern of deterioration, with multiple analysts warning of further declines ahead as inventory continues to surge. The housing market is drowning in inventory, and this is creating a perfect storm for home price destruction. Here are the numbers that real estate agents don't want you to see. In May 2025, there were 2,091,709 homes for sale in the United States, up 15.9% year over year. That's nearly 2.1 million homes flooding the market, the highest levels we've seen since the housing crisis. But it gets worse. At the end of April 2025, 9 states are above pre-pandemic 2019 active inventory levels: Arizona, Colorado, Florida, Idaho, Hawaii, Tennessee, Texas, Utah, and Washington. These were the same states that saw the biggest price increases during the pandemic boom. We're finishing 3 full years of rising inventory, and 2025 is poised to keep the trend. We have 27% more homes for sale now than last year, though we still have 22% fewer homes on the market than at the end of 2018. Here's what's really concerning. By the end of next year, we should be basically back to the old normal levels of inventory. But here's the catch. Demand has completely collapsed. The economic forces at play right now are creating multiple traps that are worse than 2008 in several key ways. First, there's the mortgage rate trap. According to the residential real estate firm Redfin, the median monthly mortgage payment in May 2025, based on Average 30-year mortgage rates and home prices is $2,860. This is only modestly below the all-time high. At the beginning of 2025, with the average 30-year fixed mortgage rate at 7%, around 31.5 million households could afford a median-priced home at $459,826. This requires a household income of $147,433. Think about that. You need to make nearly $150,000 a year just to qualify for a median-priced home. Then there's the lock-in effect trap. More than 80% of borrowers are 100% basis points or more out of the money. These are borrowers who have significant disincentive to sell their home, and this is creating the dearth in supply. But here's the paradox. As inventory builds from other sources, these locked-in homeowners are going to face a devastating wealth destruction event. We also have the construction trap. New homes for sale are at $481K, the highest level since 2007, and speculative homes for sale are at $385K, the highest since 2008. We're building at unsustainable levels while demand craters. Builders are expected to complete 1.1 million new housing units in 2025, 14% more than in 2024. This surge in supply is hitting the market just as buyers are pulling back. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. And finally, there's the affordability crisis trap. JP Morgan's analysis shows it will take about 3.5 years to restore average levels of affordability based on historical ratios of home prices to income. But their analysis assumes that mortgage rates don't decline and home values stay at all-time highs, a best-case scenario that's looking increasingly unlikely. If you're a real estate investor, the old playbook is not just outdated, it's dangerous. Here's why you need to completely change your strategy right now. The markets seeing the most softness, where homebuyers are gaining the most leverage, are primarily located in Sunbelt regions, particularly the Gulf region. These were the hottest markets during the pandemic, and they're now becoming the biggest losers. Sunbelt cities are among the top recipients of new apartment supply, including the 3 largest apartment markets in Texas, Dallas, Austin, and Houston, as well as Charlotte, Raleigh, Atlanta, and Orlando. This massive supply increase is going to crush rental yields. The multifamily market is facing disaster. 14 U.S. markets will receive more than 10,000 new apartment units each in 2025. But demand is collapsing. Since rates have backed up and rental economics have declined, builders of multifamily units have put on the brakes, but the damage is already done with units in the pipeline. Here's the new investment reality. With home ownership becoming less accessible due to rising prices and interest rates, more people are turning to rentals. And you can capitalize on this trend by investing in single-family rentals and build-to-rent properties. But here's the catch. You need to be in the right markets, not the ones that are currently crashing. Rental demand will remain strong through 2029, primarily because of underlying economic pressures. The fact that inflation and the cost of living are outpacing wage growth means that many people will find it difficult to afford home ownership. Here's why this housing downturn could be worse than 2008. First, the scale of overvaluation. U.S. home prices are currently at all-time highs and less affordable relative to income and mortgage rates than at the height of the 2006 housing bubble. We're starting from a much higher, more dangerous position than we were in 2008. Second, the interest rate environment. The situation is not going to change until we get mortgage rates back down toward 5% or even lower, and we aren't forecasting mortgage rates to breach 6% in 2025. They should ease only slightly to 6.7% by the year end. Unlike 2008, the Fed has limited ammunition to rescue the housing market. Third, the wealth effect reversal. If home prices do appreciate by 5% in 2025, the wealth effect could induce another $120 billion of consumer spending. But if prices fall, which they're already doing in 42 markets, this wealth effect reverses, potentially triggering a broader economic slowdown. Fourth, the construction pipeline. We'll see a sizable number of apartments completed in 2025 and the first half of 2026, with 1.2 million units in the under construction pipeline. This supply tsunami is hitting just as demand craters. The data they don't want you to see tells the real story. 33% of the active listings have taken a price cut from the original list price. This is a leading indicator that screams housing market distress. In May 2025, 31.2% of homes in the U.S. sold above list price, down 3.8 points year over year. There were 21.1% of homes that had price drops, up from 16% of homes in May last year. The market is rapidly shifting from seller's market to buyer's market. The nation had a 4.4-month supply of housing inventory as of NAR's April data, up from 4 months 1 year ago. While still technically a seller's market, the trend is clearly toward balance and potentially oversupply. So what does this mean for you? If you're a buyer, wait. The data clearly shows prices are falling in major markets and inventory is exploding. You'll have more negotiating power in 6 to 12 months. If you're a seller, act fast. As more homeowners face difficulties selling, significant price reductions like the nearly 20% cut seen on one Tampa property may become more common. If you're an investor, pivot immediately. Investors have the opportunity to secure long-term returns that have not been available for many years, but only if you're buying in the right markets at the right price. The housing market is sending clear warning signals that we haven't seen since 2008. The broadening of this housing decline suggests there's a shift occurring in the U.S. housing market right now. Inventory is starting to rise in most parts of the country, and sellers are beginning to wake up to the fact that prices are overvalued and they need to cut. The question isn't whether the housing market will experience a significant correction. It's already happening in 42 major markets. The question is whether you'll be prepared for what comes next. Don't let this housing market shift catch you off guard. The data is clear. The trends are accelerating, and the time to act is now. If you found this video interesting, please subscribe, share, and watch this one as well.